Hi, this is Kmot. This is the last installment of the presentation in income statement relating to financial accounting and 4. I'd like to refer to this presentation as part 4 of 3.1. I'm going to continue to look at the question paper which was written on the 10th of June 2016. And I'll be tackling operating expenses that I didn't tackle in part 3. I'm hoping that at the end of the presentation, students will be able to draft the income statement. And specifically relating to this presentation, I'm hoping that students will be able to identify operating expenses and perform necessary adjustments in order to determine the final amounts that will be transferred to the income statement. Without wasting your time, I'd like to take you to the question paper. I think at this stage, you're familiar with all the details relating to question 3. I want to continue with items that I never took into account in the last presentation, that is in part 3. I didn't take into account that item. You'll see that most of the items are highlighted. Okay, let me quickly highlight that in green because I've already taken into account of that item. So I want to start with the interest on loan. We're given the interest on loan of 14,500 as per the trial balance. Remember, when you calculate items such as interest on loan, remember that they're calculated on the capital portion of the loan, which is reflected under the balance sheet section account. So essentially, we want to calculate the interest on loan relating to that loan that was from Star Finance Company. The interest rate was given as 18% and the capital portion it's 575,000. Now we need to go to additional information to determine whether there's any transaction we need to take into account in calculating the interest on loan. There you go, that's that transaction. Because I'm dealing with that transaction, I'm going to highlight it in green because I'm going to deal to calculations pertaining to that transaction. They say provide for the outstanding interest on loan. So essentially what they're telling us is that this amount of loan that is provided in the trial balance, it's not complete. We need to take into account additional interest relating to that item. So let's quickly go to that transaction. I'd like to bring your attention to this note. There are complications relating to the calculation of interest on loan due to that note. It says the interest rate on the loan was increased by 2% on the 1st of September 2014. Currently, our interest rate is 18%. So essentially, what this entails is that before it was 18%, it was 16%. So for us to get an increment of 18% at the end of the financial year, we must have started with 16%, because if you take 16%, you add the increment of 2%, you'll arrive at the final figure of the 18%. What you see on the pre-adjusted trial balance on 28 February 2015 is an amount of the interest rate that has taken into account the 2% increment. The 2% increment has already been taken into account. So we need to determine the interest rate before they effected the increment of the 2%. I'm going to take you to the calculation slide quickly. Let's go find the calculation relating to the interest on loan. That's the interest on loan. So essentially what I'm saying is that's supposed to be its interest on loan. Of course, at the commencement of the current financial year. The current financial year commences on the 1st of March 2014. So between the 1st of March 2014 until 31st of August 2014, remember the increment took effect on the 1st of September, the month after August. So on the 1st of March 2014 until the 31st of August 2014, that is for 6 months, our interest rate was 16%. Remember, at the moment it's 18% because it's at the end of the financial year. However, before, during the 1st of March 2014 and the 31st of August 2014, before the increment was effected, the interest rate was sitting at 16%. Therefore, remember, the capital portion didn't change. The only thing that changed is the interest rate. So this is how we would have calculated the interest rate for that 16 months before the increment. We would have taken the 16%. Remember, we said 18. We deducted the 2 to determine what the interest rate was before the increment. So we would have taken the 16%, multiplied by the capital portion. There were no changes in regards to the capital portion, and would have applied the interest for 6 months. So it would have been 6/12. I just quickly want to get, a laser so that you can be able to follow me. That's essentially the capital portion didn't change. We would have applied the 6/12 because the interest rate was 16% for 6 months only. So our interest would have been 46,000. Okay, moving along swiftly, we also need to determine the interest expense from when the increment was effected. Remember, the increment took effect on the 1st of September until the 28th of February 2015. That is our current financial year. So that's another 6 months. So we need to calculate interest now at 18% because it had increased. Let me get that laser. It had increased from 1st of September. The increment took effect. Therefore, we're no longer sitting at 16%. We're now sitting at 18%. That is the 16 plus the 2 increment. We're sitting at 18%. That would have been for 6 months. So we essentially going to take the 18%. The capital portion didn't change. It was for 6 months as well. So we're going to say 18% multiplied by the capital portion multiplied by 6/12 to get to an amount of 51,750. Our interest that should be taken into account in determining the amount that will go to the income statement will be a total amount of 97,750. That's essentially how you do the calculation. I'm just going to copy this amount. I'm going to transfer that amount to the income statement. There you go. I've already explained the amount. It's 97,750. Of course, there are various other ways you can employ in calculating that amount. Can I not discuss all the ways because it will be time consuming? I always advise students that find the method that suits you better and stick to that method. Okay, moving along swiftly, that is tackled. The next thing that we're going to do, we're going to go to, remember we've exhausted all items that appear on the nominal section as we should. All those items have been exhausted. I just want to highlight in green. We didn't leave anything out. All those items have been adjusted. But you need to be careful. You also need to go to your additional information. There could be other items such as depreciation that under your adjustments and additional information that you need to take into account in computing your income statement. That item has been taken into account. The item that we still need to take into account is the creation for bad debts. So we're specifically told that we need to create the provision for bad debts. We didn't have provision for bad debts. We have to make a creation. So in creating the provision for bad debts, we're going to create an expense called provision for bad debts adjust. Allow me to write that expense there. I'm going to call it provision for bad debts adjust. I'm not able to fit the entire description as you can see because I've magnified it. Allow me to stop there. Don't worry, as soon as I punch figures, you'll be able to see figures there. Okay, let's go to the spreadsheet and calculate the provision for bad debts. Before we even go to the spreadsheet, we're given an amount of, we're going to calculate it on debtors, of course. But there are other things that we're going to take into account. But without wasting your time, I'm going to take you to the presentation spreadsheet. So we want to calculate the provision for bad debts. We're going to start with the debtors control as per the trial balance, it's given currently as 43,500. We're going to less the bad debts. Remember that there were bad debts that we needed to take into account as per the adjustments. The bad debts on the trial balance are not going to be deducted from that balance because they've already been taken into account for us to arrive at the debtors control. However, the debtors as per the adjustments were not taken into account. We cannot provide, we want to provide that we're going to lose money because people won't be able to pay the business. Therefore, we cannot provide on people that have already gone bad. Because remember, provision for bad debts, our customers have not yet been bad. We're still saying we suspect they might not pay us. But it could be due to economic conditions. As you know, currently we're facing the coronavirus pandemic or COVID-19 pandemic. I'm sure most businesses will be adjusting their provision for bad debts. They'll be hoping that people are not be able to earn income because we're in the lockdown. Therefore, they could encounter people not being able to settle their debts because people are not getting adequate income to settle some of their debts. So certain companies might want to actually adjust their provision for bad debts. Those companies, if they have identified that some of their customers have gone bad, when they adjust for the provision for bad debts, they will reduce the debtors control by the amount that has already gone bad, and then the percentage of the provision for bad debts will only be applied on the remainder, on the balance. So to cut the story short, you need to take the debtors control into account. If there were any bad debts that were not taken into account, you need to take them into account, and then you're going to apply the percentage on that amount. Let's quickly see how the percentage is going to be applied. So we're simply going to take the 5%. We're specifically told in transaction number 2, I'm thinking, please go back, check the transaction that we need to create at 5%. So that's essentially how we go about. So this will be provision for bad debts, adjustment. Remember, it will be a balance sheet item and an income statement item as well. We arrived at the amount of that figure, 1,275. I'm going to take it there, 1,275. There you go. Moving along swiftly, the next item, let's go back there. The next item, which was not under our nominal section of the pre-adjusted trial balance, but which will affect the income statement, is the creation of, let me quickly highlight that in green, we've taken that into account, is the creation of the provision of discount allowed. Okay, I'm going to highlight this because I'm going to talk about it just now. So we need to create the discount allowed. Remember, this is created on debtors, but we're not going to simply take this percentage and apply it on that given balance to determine the provision for bad debts. We're going to take other things into consideration. I quickly want to take you to the spreadsheet. Let's go to the slide calculation. There's a discount allowed. I always start with the debtors that is given as per the trial balance. We took into account the bad debts. Remember, you cannot give people that have gone bad a discount. They're not going to pay you, so it doesn't make sense. So we're going to deduct we're going to deduct the 18,000 of people that have gone bad because we no longer want to classify them as our debtors. We're going to get that figure and then we're going to deduct. Remember, we created provision for bad debts. We're not going to take into account provision for bad debts that we've just created when we do a provision for discount allowed. It doesn't make sense that the business should provide for discount, should allow people discount that are not going to pay them. So we've already determined that we might lose 1,275 attributable to bad debts. Therefore, we're not going to provide for those people. So we're going to reduce the amount of debtors by the provision for bad debts to determine the amount that we're going to apply the percentage of the discount allowed. So basically, we came to an amount of 24,225, we're going to multiply that by 8% to determine our final figure relating to provision for discount allowed. So I'm going to take that amount, 1,938, 1,938, allow me to write it quickly. It relates to provision for discount allowed. I just decided to shorten it. Okay. For discount allowed. There you go. Provision for discount allowed. There you go. Moving along swiftly. That item has been calculated. We dealt with that. That's done. Let's go look at other adjustments that we didn't take into account in determining our income statement. That has been taken into account. It looks like the only transaction that we still need to take into account is the calculation of depreciation. Let's quickly read. There could be complications. Provide for depreciation as follows. On vehicles at 15%. On cost price, please, you must be able to clearly distinguish between cost price and the reducing balance or diminishing balance method. I quickly want to start with the calculation of depreciation on equipment according to the diminishing balance. I actually didn't even do a slide to show you calculations, but I hope you'll be able to follow. So I'm going to say depreciation. For calculation purposes, I've decided to separate it. So it was depreciation on equipment, you don't have to separate this, but for calculation purposes, I've decided to separate this. So this was on reducing balance. What reducing balance means, or diminishing balance, diminishing method. Diminishing method or reducing balance or carrying value method are essentially the same. What this entails is that you're going to take your equipment, the cost of equipment, which is 430 at this stage, and you're going to less the accumulated depreciation. Accumulated depreciation, which is 8920, you're going to less that, and then you're going to apply the percentage to arrive at the value of depreciation. Let's take it as we speak. It's 430. I'm going to establish a bracket, so it's 430 minus 89. Let's quickly go check there. Minus 89,200. And we're going to multiply by the given percentage. We're given 15%. That's essentially the reducing balance. 12%. 12%. I hope I got it right. 12%. There you go. That's essentially the reducing balance. So reducing balance, you take the cost price, you less the given accumulated depreciation relating to the previous year, then you multiply by 12% in order to determine depreciation for the current year. This is reducing balance. It's also referred to as diminishing balance. Okay, the next depreciation I want to do is depreciation relating to vehicles. Let's quickly go check the information. We were specifically told, we're doing transaction number 10, highlighted in green. We were specifically told that vehicles depreciation should be provided at 15% on cost. This is easy. You simply take the cost price, you multiply by 15%. However, that note brings complications. It brings complications in the sense that we need to take into account the fact that our vehicles has not always been 950. So we cannot take the 950 and apply the 15%. We need to split this into two amounts. One amount relates to vehicles that has been in existence for the entire 12 months, and the other, the 250, we were specifically told, relates to equipment that was only in the current year from December. So that would be December, January, February, for 3 months. So we need to split it. We're going to do the depreciation calculate the depreciation on 250 at 15%, multiply by 250, multiply by 3/12, because that vehicle existed specifically for 3 months. Let me take you to the calculation slide, specifically relating to depreciation. There you go. That's what I spoke about. So I'm going to take the vehicles as per the trial balance. The purpose of this exercise is to split between two values where we're going to calculate depreciation. The 950 is what we have as per the trial balance, is the total of our vehicles, including new vehicles. I'm going to deduct the amount of vehicles to arrive at the value of vehicles before the entity acquired new vehicles. Now, the calculation of my depreciation will consist of the application of the 15% on the 700,000 that existed for 12 months. The 700,000 existed for 12. It has been in existence from the 1st of March 2014 until 28 February 2015. However, the 250 only existed for 3 months. Remember, we acquired new vehicles on the 1st of December. So if you count, it will be 1st of December, first month, January, second month, February, third month. So this vehicle only existed for 3 months. So we should only determine depreciation for 3 months, specifically relating to that 250. So this is essentially how we would have calculated the depreciation. It's 700,000 multiplied by 15. That has existed for 12 months. So you multiply by 12 over 12. You actually didn't have to do that calculation. I just wanted to show you the contrast between that asset and that asset. Okay, let me go back a little. Apologies. So essentially, to determine the amount that will be taken to the income statement, we're going to calculate depreciation there, and then depreciation by taking the 250 multiplied by 15% and appreciating the fact that it only existed for 3 months in the entire 12 months. We're going to get an amount of 114,375. I'm going to take that to the income statement. So it's 114,375. Let me quickly check if 114,375. 114,375. There you go. That's it. There's nothing else. I've taken all expenses into account. The last thing that we need to do is to determine the net profit. Net profit, we simply go say sum of, I'm going to say sum of those two, enter. So that's our net profit, 90,739. Thank you. This is where the presentation ends. I just quickly want to, this is a magnified version. I want to reduce the font. Let's see what happens. I'm just quickly going to reduce it so that you can see the entire thing. I'm going to take it to 16. I'm not sure if you're able to see the entire thing. Okay, I want to reduce this. There you go. That's essentially how it looks like. Can I reduce it further? I'm not sure if you'll be able to see. If I do that, 14. That's essentially how your final income statement looks like. Thank you. If you've got any questions, please, you can post them to my email address. Thank you, guys.